how to loan funds from your SSAS to your sponsoring limited company. Let's go back and remind ourselves what this looks like. You have the limited company, which is acting as the sponsor to the SSAS, and it must be and let's say there are two members here, and we've got two directors up here, husband and wife, which is a fairly typical scenario. So don't forget, the company may make contributions to the SSAS for its members. We've got a husband and we've got a wife. As we know, as you will have seen, if they have pensions elsewhere, so let's say they've got SIPP, because you can't do this with SIPP, of course, and you've got personal pensions, then the members can arrange to transfer those funds into the SSAS, therefore increasing the value of the SSAS. So how much can a SSAS lend back to the limited company? Well, it is a maximum of 50% of the net scheme assets. So, assuming there is no other borrowing inside this SSAS, and it's probably just easier to assume that, let's say all the assets are cash or just held on deposit somewhere. If the value of this SSAS, and don't forget it's a combined value, it's the SSAS doing it as one. Let's say the value here is £200,000, which is contributions and transfers that have come in, then clearly the maximum loan back to the sponsoring employer would be £100,000. So that is your max that you can do. When we're doing a loan back to the sponsoring employer, and it must be the sponsoring employer, the criteria set down by the Inland Revenue is quite strict. So to run through the criteria for a loan back to the sponsoring employer, and it is very strict, the term must be a maximum of 5 years. It must be on a capital and interest basis. And the way that's calculated is also very prescriptive. The Revenue asks us to calculate the total interest payable over the 5 years and add this on at the beginning. The loan to the sponsoring employer must not be for cash flow or to bail the company out. It must be to help the company develop and grow. That is a fairly wide definition. It's difficult to be a little bit more specific than that, but that's broadly where they're looking. And you must have security for this loan. And that security must be on a first charge basis. Nothing else will do. And it is also essential that the security offered to the pension scheme is to the value of the loan plus the interest. So it must be worth at that value or more. And it also has to be security that is acceptable to the pension scheme, because we have to work on the basis that if the company defaults on its payments, then the security offered must be able to be seized by the pension scheme. So classically, the assets that we typically take security on are commercial property. So you have to have an unencumbered commercial property, or you have to have a commercial property. It doesn't have to be owned by you, which is an important point to note. If you have somebody else that owns commercial property who's prepared to let you use it as security, so obviously there's going to be a fair degree of trust there, then you can use that. So commercial property is ideal for security. Land would also be another asset that is acceptable as security. And on occasions, we are also prepared to look at taking a debenture over the shares in the sponsoring company. Now, I need to define that for you a little bit more. We won't take a debenture if the company has no value behind it. So if the value of the company is really, let's say, the directors and what they know, that would not work. We need to see a company that perhaps has an excellent order book or has other assets that it owns worth far more than, say, the any loans that are outstanding. That way, the debenture would actually be a meaningful debenture over the value of the shares. So again, talk to us about that. I think it's also very important to highlight what is not acceptable as security, because we do get offered all sorts. You cannot take residential property as security, even via a third-party security trustee. That you cannot do. Again, because the revenue will deem that the pension scheme has come into ownership of an asset that is not acceptable and would raise a tax charge against the pension scheme, which of course is the last thing that you want. It cannot take security on goods and chattels. I think the best one we've been offered was an ocean-going yacht a few years ago. The answer is no. Obviously, it could sink. And they are depreciating assets as well, so we cannot take security in those. So just to re-emphasize, the security ideally must be commercial property worth more than the loan and the interest, and or land, and possibly a debenture over the shares in the company. If we can take a first charge over one of those assets to secure the loan, then we can do a loan back to the sponsoring employer. Don't forget, must be a maximum of 5 years, and capital and interest payments must be made. If you miss the payments, it's a reportable offence to the revenue, and they will issue a tax charge accordingly. So if you're going to do loans back to the sponsoring employer, and it is a great facility inside SAS, and you certainly can't do it inside SIPP, you need to make sure that you take the commitment on very seriously indeed. We'd like to hear from you. Are you considering a SAS loan back to your company? And how do you think it would help you? Please leave a comment below.
Book a call with us via the link in the description below. If on a mobile device, simply hit the More button under the video title and pick a convenient time to speak. Feel free to share this video with others that may benefit on WhatsApp or in other online groups or channels. Like, subscribe and hit the notification bell for lots more SAS related content, and leave a comment if you found this video helpful. For more, visit onecrownpensions.com.